Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, in this installment, we're going to talk about strategies to reduce the taxation when converting your money from an RRSP account to a RRIF or a registered retirement income fund. So we'll go through different strategies to try to reduce the tax bite on that rollover. Now, if you're new to our channel, make sure you hit the subscribe button. We're posting content all the time on different aspects of retirement income planning and overall wealth planning. And if you're curious about how you can get your own complimentary retirement analysis, just visit the show notes to the link for our website, and you can find out how you can get your complimentary retirement plan. Okay, let's talk about the strategies to reduce taxation when converting the RSP to a RRIF. So first of all, if you haven't made use of capital from your RSP account or RRIF account before the age of 71, age 71 is a critical date. By the time you get to your 71st year, by December 31st of that year, you have to transfer your RRSP capital to a registered retirement income fund or a RRIF account. Now that transfer can be done on a tax-deferred basis, and the timeline is such that the paperwork has to be done in your 71st year, and the statutory requirement for a payment, the minimum payment you have to take out, doesn't have to come out until your 72nd year and has to come out by December 31st of your 72nd year. Now, a few things to keep in mind with the payment. So first of all, the minimum required payment has to come out whether you need the income or not. As well, you are perfectly free to be able to take out additional income if you want more income than the minimum payment. So the minimum has to come out, and then if you need to take additional income, of course, you can do that from the account. So those payments would be taxable to you in the year that you take the payments out. As well, any assets accruing and growing growth over time grow on a tax-deferred basis. So they don't actually become taxable until you actually take the money out of the registered retirement income fund. Okay, now you've gone through the process, you've looked after the paperwork for your conversion from an RSP to a RRIF in your 71st year. You have to begin taking payments now in your 72nd year. Those payments will not be taxable. So are there ways you can reduce the tax bite? So there are a few things to consider. So first of all, if you have a spouse or partner, if they're younger than you can use your younger spouse's age in the RRIF minimum calculation. So that can reduce the amount of income that you'll be forced to take out. And I'll show you later in this video a couple of calculations where I use the individual who has to RRIF their age and then their spouse's age, who's younger, to show you the difference between the two. The second thing is if you don't need the RRIF minimum payment, you might be able to use that money to invest tax effectively. A couple of options. So one option is if you have RSP room, although you're over the age of 71, you're now in your 72nd year, you can't make an RSP contribution to your RSP account, but if you have a partner, you can make an RSP contribution if they're under the age of 72 to their spousal RSP. So you're able to still make contributions to a spousal plan, still get tax deductions using that strategy. If that opportunity doesn't exist for you, then another strategy is to use that money coming to you to top off your tax-free savings account. So let's say you've got some tax-free savings account room, you haven't maximized it, you can push that RRIF minimum payment into that account, and at least the money inside that account will grow on a tax-free basis. And then the third option for that cash flow coming to you, if it's not needed, is you can use it and invest in a non-registered account. So if you've already looked after your tax-free savings account contributions, you can then add money to a non-registered portfolio, and you might still be able to get some tax advantage by investing in assets that will generate some dividend income, maybe some capital gains income, and not purely interest income, which is fully taxable. Okay, so now you're getting the income. What about your tax returns? Are there some opportunities for reducing the tax bite? So the first thing to be aware of is that registered retirement income fund income at age 65 and beyond can be split with your partner. So if you have a partner, upwards of 50% of the payment, let's say you're getting $10,000 from your account, upwards of $5,000 can be split to your spouse and claimed on their tax return. So it gives you the ability to potentially reduce the overall tax burden on that payment. Obviously, that's beneficial if your partner is at a lower tax rate. The second thing is you can effectively double up on your pension income tax credit. So federally, there's a tax credit of $2,000. So if you have $5,000 of income, you can qualify from that RRIF payment for your tax credit. If you push $5,000 to your spouse, they can qualify for that tax credit for pension income if they don't currently have any qualifying pension income. So it's a wonderful way of effectively doubling up on the tax benefits of the pension income splitting rules, both the reduction of taxation if your spouse has a lower tax bracket than you, and then doubling up on the pension tax credits. Okay, let's talk about some estate planning considerations for your registered retirement income fund. So first of all, when you go through the application process, you'll be asked about beneficiary designations. If you have a surviving spouse or partner, you'll be listing them as a successor annuitant, because if you're getting regular income payments from the RRIF, a successor annuitant in a first-to-die situation where you die prematurely will continue to get the income payments without interruption. So it's a great peace of mind exercise for your partner or spouse. Now, you could list as well your children as contingent beneficiaries. So the benefit of that is you die prematurely, your partner then dies, and then the assets will automatically be paid out in that scenario, in a last-to-die scenario, to your children without having to be going through the probate process. So it's quicker, it's not as administratively intense to get the money to the kids. Now, the one downside to that, and I always say to my clients, make sure that your executor and your kids are aware that there will likely be a tax bill due on that RRIF account. So you want to be aware of that, have an approximate dollar amount, and just plan as a family how you're going to deal with that tax bill. So the direct beneficiary designation is a more streamlined way of handling estate settlement, but it doesn't do away with the tax bill, which is still going to be due, and the family has to figure out what the mechanics will be to get that looked after. Now, as well, you can have charities listed as a beneficiary. So one of the benefits of that is upon death in a last-to-die scenario, that account would be taxable, the RRIF account. But if the money is going to a charity, they'll issue back a tax receipt, and that will offset maybe not all the tax, but quite a bit of the tax bill that's triggered. So you get your cake and eat it too. Your legacy aspirations are looked after, and the tax bill is covered off, at least a portion of it, through the receipt that the charity issues back to your executor in the year of death tax filing. It will reduce the tax bite. And then finally, there are provisions in the income tax code that if upon death there's a payment that goes to the estate, normally it will be taxable. However, in situations where you have financially dependent children under the age of majority, or children with mental or physical impairments, no matter what their age, there are some tax deferral mechanisms in the tax code to reduce the immediate tax bite in the event that in a last-to-die scenario there is a death. Normally there'd be potentially a large tax bill, depending on how old the person is at that point. That tax bill could be deferred or reduced if you have family members in those circumstances. So earlier in the presentation, I talked about the RRIF calculations using, let's say, your own age. Let's say you've got a spouse or partner who's younger than you. So in this example, we're using the older age for the annuitant, the person moving the money into a RRIF. We're using $200,000 of value. We're using the 72nd year. And if you look at we're not using the spouse's age, we used a 4% rate of growth on the account, and we're starting the RRIF payments immediately. So you can see in the calculation that's going to kick out a minimum payment of $10,800 on a pre-tax basis. That's 5.4% of the overall account value. And you can see the percentage withdrawals in the RRIF minimums. They go from 5.4, 5.53. By age 80, we're up to 6.82%. And you can see that at a 4% growth rate, looking at these percentages are going higher. The percentages in my example are higher payouts than the rate of growth in the portfolio, and you can see the value of the accounts going down every year. So this 10.8 is based on the age 72. Now let's say that the spouse is younger. Let's just click this. So younger age spouse, we'll say yes. And then we'll say the spouse is age 65, and we'll go down and look at the calculations. And you can see that the payment's gone down from over $10,000 per year to $8,000 per year. And the withdrawal percentage is now down to 4%, so it's a lower withdrawal rate. So it's just one of the tools that you can think about when you're looking at payments. This particular tool is in our website. So if you go to our website and you go to, I'll just show it to you here. So go to Humphrey's Wealth Group. You'll come to this homepage where there's information about how you can get your complimentary retirement plan. You go down to the bottom of this page and you'll see the toolbox listed. Click Toolbox, and then go down the bottom. You'll see online calculators, and then you can get yourself to the various calculators. And one of them is the RRIF payment calculator. Okay, so hopefully that was helpful for you. Well, it's my hope that you found this video helpful. Again, if you're thinking about retirement or already retired, make sure you go to the show notes. There's a link to our website, and you can find out how you can get your own complimentary retirement income planning forecast. And if you don't want to miss future content, make sure you hit the subscribe button. We're posting content all the time. And if you enjoyed this video, be sure to click like. Wishing you all the best in your retirement planning and wealth planning journey.